Let's consider some specific examples of government securities. So at the top of this exhibit, I have some of the larger issuers of government debt worldwide, and some of the terminology. So in the case of U.S. Treasuries, they issue a variety of different securities, and we'll look at these in some detail in the next exhibit, but there's Treasury bills, Treasury notes, Treasury bonds, and what they call TIP securities, Treasury inflation protected securities. But you see similar sorts of securities, although with different names associated with them. So in the case of Germany, they issue blue bills. Well, that's the equivalent of treasury bills in the United States. Or there's the Schatze. Those are the 2-year German government securities. Or the Bobbles. Those are the 5-year German government bonds. And there's Bunds, although there's both 10-year and 30-year Bunds issued by the German government. And in fact, like U.S. Treasury securities, German Bunds can be stripped. You can separate the cash flows, separate the interest payments from the principal payments, and let the two trade separately from one another. Gilts is the generic word that's used to refer to British government bonds. By the way, gilts is short for gilt-edged stocks. And you'll note in the UK, stock doesn't mean equity security the way it means in the United States. Stock is synonymous with security. Any sort of security, whether it's fixed income or equity sort of security. In the UK, equities are referred to as ordinary shares, for instance. Or in Japan, there's the JGBs, Japanese government bonds. Italy is one of the major issuers of government debt. In fact, the 5 countries I have listed up there are among the 5 largest issuers of government debt worldwide. Now, just briefly about the issuance of government debt, to give you sort of a counterpoint with what I had said earlier about how most corporate issuers and local and regional governments, since they're not large enough and frequent enough issuers of debt securities, they will hire underwriters to do the distribution of the securities on their behalf. But large issuers, such as the countries I've identified here, and many others, by the way, because they're such large and frequent issuers, they will sell their securities directly through what is known as a yield auction. Now, why is it called a yield auction? Well, because the auction process itself is going to be what determines the yield at which the securities, the yield on the price, at which the securities are actually issued. So unlike the firm commitment underwritings I talked about before, those are usually fixed price, fixed rate, and by rate I mean a set yield to maturity, at which all the securities are going to be sold. But generally for government debt, they simply announce the maturity and the size of the debt offering they want to make, and they let various market participants bid on the offering, and they're bidding competitively with one another. And through that competitive bidding process, that in effect determines what the price and yield on the offering is going to be. Because unsurprisingly, they sell the bonds first to those who have bid the highest price, although many of these auctions are phrased in terms of the lowest yield you're willing to get. But yield and price, as I've been trying to indicate, are 2 different ways, that is, yield to maturity and price are 2 different ways of expressing the same idea. So you can conduct auctions on either basis, but it's most common that the bids submitted are expressed in terms of the lowest yield you're willing to accept. So through this competitive process, you end up selling the bonds to those who are in effect bidding the highest price, and you sell until you run out of securities. So in many auctions by, say, the U.S. Treasury, you might have bids 2.5, 3, 4 times the size of the offering as a whole. So it's this competitive process that determines the effective yield at which the securities are sold. That's why they're referred to as yield auctions. Now, in many of these auctions, they're variable price and variable rate auctions. In other words, each successful bidder ends up paying the price they bid, and consequently they're buying those securities at different prices and different yields. Although there is also a significant number of such auctions that are structured as a single price, what are sometimes called Dutch auctions. In other words, we'll allocate the securities in the same way that I referred to previously. Highest bidder gets their order filled first, second highest bidder gets their order filled next, third highest bidder in sequence after that. And we simply fill the orders highest bid until we run out of securities to sell. But if it's structured as a single price auction, well, while we'll allocate the award of the bonds in exactly that fashion, everybody who ends up, that is all institutions and individuals, that ends up getting their bids accepted will end up paying the same price and thus have the securities issued to them at the same yield. And it turns out it's going to be the average of the accepted bids typically. And then in many cases they use what's called a TAP system. In the U.S., they refer to that as reopening older issues. In other words, every time the U.S. Treasury sells securities, it's not actually a new issue. In some cases, they're selling some securities they issued 1 or 2 months previously. The benefit of that? Well, by selling more of the existing issue, that means there's more of that issue outstanding. And one of the factors that affect the liquidity of an issue is how much of that security is outstanding. And the more security outstanding, or I should say the larger the size of the issue outstanding, the more participants that are buying and selling and trading and investing in that security, and consequently the more liquid that security is likely to be. So it's actually very common, both as a way of enhancing the trading attractiveness, the liquidity of the existing issues, and it's also less expensive than conducting a formal auction process. Well, let's look at the specifics in one market. In fact, let's look at the U.S. Treasury market in particular, as it is the largest single securities market worldwide. There's currently something in the order of $11.5 to $12 trillion worth of Treasury securities outstanding. That's U.S. Treasury securities. So the U.S. Treasury issues 3 types of securities. They issue Treasury bills, Treasury notes, and Treasury bonds. Now, there are other Treasuries traded, what they call Treasury strips, not issued by the U.S. Treasury. They're created by investors. We'll talk about those briefly in a few moments. And there's also some Treasury securities that have a special inflation protection feature, the inflation index Treasuries. We referred to them earlier as TIPS, common acronym used in the market because they're oftentimes referred to as Treasury inflation protected securities. Well, this isn't a different category of securities. It's certain selected designated issues of bonds or notes, not all, but certain designated issues that are given the special inflation protection feature. Well, let's look at the characteristics of the bills, bonds, and notes, and then we'll talk briefly about TIPS and strips as well. So here you see an exhibit that tries to summarize the features of those 3 major categories of U.S. Treasury securities. And we can distinguish amongst them along 3 different metrics. We can distinguish among them based on their time to maturity. We can also distinguish between them based on the way they pay interest, as well as in terms of how they're quoted. Although, as you might have noted if you've looked ahead at the exhibit, that in the case of bonds and notes, there is no difference in terms of the way they pay interest and how their prices are quoted. They only differ in terms of their time to maturity from issuance. So if we look first at the maturities, Treasury bills are securities with a year or less to maturity from the date they're issued, and the flavors in which they're currently being issued, I should say maturities in which they're currently being issued, are what are called 1, 3, and 6 month securities, as well as a 1-year T-bill, which I've called 12 months here, but in the market they refer to it as the 1-year bill. Understand, however, these are names. They're not actually descriptions of the time to maturity. What by convention is called the 1-month bill is actually a bill that's issued with 4 weeks or 28 days to maturity. Similarly, what's called the 3-month bill is actually a security with 13 weeks or 91 days to maturity, etc. So understand these are names, not exact descriptions of the time to maturity. T-notes, on the other hand, are securities that have between 2 and 10 years to maturity from the date they're issued, although what's currently being issued, as indicated here, are 2-year, 3-year, 5-year, 7-year, and 10-year T-notes. Although they're auctioned at different frequencies, the 2 and the 5-year are auctioned off on a monthly basis. Although remember the TAP system we talked about previously, some of those issues will sometimes be, well, these will not be used the TAP issue here, but they'll be issued on a monthly basis. But the other 3 flavors of T-notes, which are issued on a quarterly basis, in some cases you'll see those sold in the months between the 4 quarterly refundings. Every February, May, August, and November. Well, those are the quarterly frequencies, or the months in which the quarterly issuances take place. Sometimes you'll see the 3, the 7, and the 10-year sold on the off months. Those aren't new issues. Those are reopening the old issues. And T-bonds are securities that have anywhere over 10 years to maturity from the date of issuance. But if we ignore the TIP issues, or set the TIP issues to the side, the only maturity of regular Treasury bond the U.S. Treasury has issued since at least the late 1960s is a 30-year T-bond. Now, the other metrics that we talked about that allow us to distinguish between securities, or the Treasury securities, well, there's no other differences beyond time to maturity between T-bonds and T-notes. They both pay semi-annual coupons, which I said is the norm in many market sectors in the United States, and they're both quoted by percent of par, with the minimum price fluctuations being expressed in terms of 30 seconds of a point. But if we look at T-bills are distinctly different in those last two metrics, because T-bills don't pay a coupon rate of interest. Rather, they are discount securities. In other words, if I were to submit a bid on a T-bill at one of the weekly Monday auctions for a 3 or a 6 month T-bill, and let's say for the sake of example, I submitted a bid for a $100,000 par value, face value T-bill. And let's say based on the auction results, I was going to end up paying a price of $98,750. Well, if that's the price I pay when the auction settles, and say it's a 3-month bill, so 3 months later as it matures at the $100,000 face value, that means my interest for holding the T-bill to maturity was the $1,250 discount to face at which I purchased it. So in other words, it works just like a zero coupon bond, but they use the phrase discount security when the initial time to maturity is a year or less. And like most other short-dated debt securities, money market instruments like T-bills are not typically quoted on a price basis. They're quoted at a rate basis, and the specific name of the interest rate that's used to express the value of T-bills is known as the discount rate. Now let's consider corporate securities. We've just discussed governments. Let's consider the ways in which corporate securities differ from Treasury securities. And it's not in terms of the basic concepts we talked about earlier, par and coupon and face value. We'll see those sorts of things on corporates just like we will with Treasuries. But there are significant differences. Some we've touched on already, the credit risk aspect we touched on briefly. But the other is that you're more likely to encounter embedded options in corporate securities than you are in government securities. So consequently, when we focus on the unique risks that we're exposed to, or relatively unique risks we're exposed to in the holding of corporate securities or investing in corporate securities, those are two of the major considerations we'll have to take into account when assessing the likely risks we're facing versus the expected return. So note that the big risks are related to the uncertainty of repayment, and part of that the uncertainty of the cash flows. Part of that is the uncertainty of the repayment, those credit risk issues or default risk issues we talked about previously. But the other thing that causes us to be uncertain about the cash flows is the life of the investment itself, because the life of the investment can be shortened by the issuer calling the security. And then aside from those uncertainties, you also see many things in government, or I should say in corporate securities, you don't see in government securities. And that's because oftentimes the issuer will structure the debt as a way of trying to offset investors' concerns about those various risks. So oftentimes if government securities are callable, they're callable at par. Not corporate securities. If they're callable, they're likely to have to be called at a premium to the par amount, as we talked about earlier, because the existence of a call works to the benefit of the issuer, not to the benefit of the investor. Or because of the uncertainty about the issuer's ability to pay, the credit risk, you'll see lots of features built into the bond contract that try to reduce investors' concerns about the possibility of default. There might be assets pledged as collateral. The issuer might promise to abide by certain strict financial tests, maintaining a certain level of net worth or equity, or possibly the promise to adjust the coupon upward if the company's credit rating is cut. So oftentimes corporate bond analysis is much more involved, not because you simply have to assess the business of the issuer, but you also have to look at the terms of the bond contract and understand how the provisions of the bond contract might to some degree offset or allay your concerns about risk, or in other cases might increase your uncertainty about the future cash flows. And all those provisions are written into what is known as the trust indenture in many cases. So again, the trust indenture, which we touched on briefly previously, a trust indenture is basically a contract and that contract will state the rights of the bondholders. I'll say rights of holders, but that's bondholders. And obviously they have certain rights, like the right to receive interest and principal according to the schedule of payments, but they might have other rights as well. They might have the right to convert the bond into some other security, or they might have the right to put the bond back to the issuer. All those rights have to be expressed explicitly in the bond contract. The contract is also going to identify the obligations of the issuer. Obviously, they have the obligation to pay interest and principal according to the terms of the contract, whatever the schedule of payments are, but they might face other obligations as well. And in fact, those obligations are typically expressed in covenants. Now, there are both standard covenants that are just sort of administrative, the mechanics of how the issuer is going to get the money to the investors, who's the paying agent paying the money on behalf of the issuer. If there's a legal dispute, under what law would the dispute be adjudicated? New York law, London law, as the case may be. But there's also many what they call protective covenants. That is, covenants that are written in to force the issuer to abide by certain patterns of behavior, to maintain certain financial tests or meet certain financial tests to be in compliance with the contract. And let's look at a few of those. And actually, before we look at some of those other issues, let's look at the manifestation of some of those issues in a diagram like we looked at previously. Now remember, we earlier talked about yield curves and how corporate yield curves are set at a premium to government yield curves. And those premiums reflect the risks we talked about previously. And remember, we said that that spread between the yield for a given maturity, so that if we're talking about, say, a 10-year maturity, and we're looking at the 10-year maturity government security, and also looking at the 10-year maturity on some corporate issue. Let's say this is the AAA rated corporate yield curve. Well, let's say it's the AA rated corporate yield curve. And what causes there to be a spread between the Treasury rate and the AAA rated corporate rate are the lesser liquidity of corporate securities, which means they have more liquidity risk, the credit risk of the issuer, which is a function both of the industry in which the company operates, as well as company-specific considerations, as well as any embedded optionality, the fact that the bond might be callable or puttable. Although, again, put provisions are very uncommon, and for what it's worth, a put provision would cause a bond to trade at a lower yield, other things equal, because puts enhance the investor's investment. They're favorable to the investor. Anything that's favorable to the investor would cause a bond to trade at a lower yield, but anything that worsens the bond as an investment from an investor's perspective, and clearly if the issuer has the right to call the bond, that helps the issuer, not the investor. Callable bonds will trade at higher yields than otherwise similar non-callable bonds. So that's what leads to the spread, is the market's reaction to those different risks that you're facing in corporate bonds versus Treasury securities. And while we saw in that last exhibit the manifestation of the differences in risks and how it affects yields on same maturity bonds from the government sector versus the corporate sector, I've talked in general about the impact of embedded options. Let's look at it more specifically. Because non-callable bonds that is bonds without any embedded options for early retirement, so non-callable bonds primarily, they will exhibit what's known as positive convexity. And this curvilinear function that you see right here is a manifestation of the trade-off between yield changes and price changes on any non-callable bond. And you'll note that as yields are rising, a bond price is falling, because remember, bond prices and yields do move inversely to one another, but you'll note that as yields go up, the price declines are moderating. A graphical interpretation would say that, well, the flatter the slope of the function, since we're measuring price changes along the vertical axis, the flatter the slope of the function, the less sensitive a bond's price is to a change in interest rates. And you'll note for non-callable bonds, as yields go up, the bond's sensitivity of price to yield changes gets less and less. Conversely, as yields fall, not only does price appreciate, the steepening of the slope of the price-yield function indicates that as yields fall, a bond's price is getting is getting more sensitive to interest rate changes as yields go lower and lower. Well, this shape is referred to as positive convexity, because the trade-off between price and yield is generally working in the investor's favor. Yes, as yields go up, the price goes down, but the price declines are moderating because the bond's price is getting less and less sensitive to rate changes as yields are rising. And conversely, as yields are falling, not only do you get price appreciation, but the steepening of the slope of the price-yield function indicates that the bond is appreciating more and more rapidly as yields go to lower and lower levels. So when talking about this from the perspective of an investor that owns bonds long, clearly that sort of trade-off between price and yield changes is beneficial. I lose more slowly when the market's moving against me. I gain more rapidly when the market's moving in my favor. But remember, many corporate bonds will have an embedded call option. And anytime what you have is a callable bond, that sort of security will exhibit what's referred to as negative convexity. And that implies the opposite sort of curvature in terms of the way that price and yield change relative to one another as time passes. So you'll note that in this diagram, as yields are rising, not only do we see price declining, the price is declining at an accelerating rate. Clearly not a good thing. Conversely, as yields are falling, yes, you're getting price appreciation, but you'll note the flattening of the price-yield function as you go to lower levels indicates that the bond price is becoming less sensitive to yield changes as yields go lower. Well, you'll note that's exactly the opposite the trade-off I described for non-callable bonds that exhibit positive convexity. And what causes the negative convexity is, in fact, the embedded call option. The fact that the bond is callable is placing an effective ceiling on how high a bond's price is likely to appreciate. Because you're not likely to see a bond that is callable in the near future to trade at a very big premium to the call price. And note again, as yields rise, not only is price declining, but the price declines are accelerating. Now, of course, this is not a death spiral. If yields go up far enough, there's going to be an inflection in the price-yield function, and it will shift over to positive convex shape, but that's only once the security is already trading at a fairly significant discount to par. So over the range of yields where callable bond prices are usually trading, they exhibit that very adverse trade-off from the investor's perspective. So you can see that the existence of a call is negative from a number of perspectives, but when looking at how the existence of that call provision affects price, it causes less appreciation when prices are declining, or I should say lesser appreciation when yields are declining, and accelerating depreciation when yields are rising. Clearly an unhappy trade-off from the standpoint of investors. So let's look at some of the details on corporate securities. So remember the credit differentiation, or the credit risk differentiation across different issuers. So that clearly it's not a single category of credit risk. Some well-financed companies with strong businesses, they represent very minuscule credit risk, especially if they have very predictable and stable revenues and cash flows over time. On the other hand, other companies are in very volatile businesses where even if their business is strong today, if, say, the pace of technological change is very rapid, What is a dominant company today might be a very minor player over just a couple of years. I mean, look at BlackBerry, or they used to be known as Research in Motion, went from the #1 producer of smartphones 3 or 4 years ago to today their market share is almost unmeasurable. In fact, they're exiting the consumer business. So there's a wide variety of credit risk exposures and corporate securities, all the way from the very safest. And as we talked about security, or talked about previously, that would be those securities that carry a AAA rating. Although again, investment grade runs all the way down to, well, literally it's BBB minus or Baa3, or sometimes people say Baa-3. And clearly, even among the investment grade, there's a tiering of credit risk. Very few, almost no AAA rated companies ever default. Whereas companies at the very bottom tier of the investment grade rating, it's not that the majority of them default, but whereas the level of defaults by AAA rating is a small fraction of 1/100th of 1%, if you look at the history of time, oh, well, no, the number of defaults by BBB rated issuers over the long stretch of time might be fairly significant. Not the majority, but maybe 2, 3, 5% of such issues will experience a default over the life of the security. Anything with less than investment grade rating is what's considered a high yield bond, or by some people, junk bonds. And that simply means they have less than an investment grade credit rating. But apparently the market overcompensates for the actual level of default, because as I'd mentioned earlier, if you look at returns over long stretches of time, not necessarily any 1 or 2 or 3 year period, but if your holding period is 4 or 5 years or longer, it's hard to find any consecutive 4 or 5 year period in the last 20 or 30 years where junk bonds have not generated the highest cumulative return over that period of any sector of the taxable bond market. And when we're assessing credit risk, oftentimes people talk about the 4 C's. What's the capacity of the borrower to repay? Well, that's primarily a function of the strength of their business and their access to capital, whether that be through lines of credit or the ability to tap the bond market, or maybe having very valuable assets that could be sold to raise money to pay off the debt. What's also important are the protective covenants we talked about before, and we'll look at those in a little bit more detail in a few moments. One of the ways of allaying investor concerns about credit risk, if you're less than a top-rated borrower, is by offering valuable assets you own as collateral to the bondholders, such that if the company cannot pay off the debt out of operating cash flows or other sources of cash, the bondholders can repossess that collateral and sell it to recover as much of the debt owed to them as possible. And then finally, character. In other words, does the company have a culture? Is there a current management team that has exhibited a strong commitment to paying off their debt in as timely a fashion as possible and adjusting the company's operations to make sure that the bondholders' investments is being administered, or the money being managed on their behalf by the corporation is invested in such a way to make it very likely the bondholders are going to receive all their interest and principal in a timely fashion. So let's consider in a little bit of detail some of those covenants we talked about previously. Now again, these are all provisions in the bond contract, and many of them are standard, like how are we physically going to move the money from the issuer to the investors? Oh, they'll identify a paying agent where the money can be obtained or will be sent to the investors from. And there's many, many standard provisions. Just to give you an example, almost all bond contracts have a grace period. In other words, if an issuer doesn't pay a coupon payment on the coupon payment date, is that going to be a default? Well, yes, unless there's a contract provision that gives the issuer an out. And since the issuer, in conjunction with its financial and legal advisors, is drawing up the contract prior to the public offering, the vast majority of corporate bond indentures will have a provision that includes a grace period, typically of 15 to 30 days. So if that grace period is written into the trust indenture, that means even if the issuer doesn't make the coupon payment on the coupon payment date, it's still not a default. It's not a default until that grace period, that 15 or 30-day period written into the contract lapses. Only if they haven't made the payment by the end of the grace period is it actually technically a default. But let's focus on the contract provisions that we're usually concerned with that affect our perception of the bond's credit risk. And oftentimes those protective covenants are expressed as either affirmative or positive covenants, that is, contract provisions that obligate the issuer to do something, take action to make sure that the bondholder's investment is safer. But there's also negative covenants or restrictive covenants that prohibit the issuer's ability to take action that might undercut their ability to pay off the bondholders as their claims come due. So examples of each. Examples of affirmative or positive covenants would be meeting certain financial tests, like a company might have to maintain a certain level of net worth, book value of assets minus book value of liabilities. Or they might have to maintain a certain level of working capital, current assets minus current liabilities. Now, a specific accounting discussion of those calculations is beyond the scope of this discussion, but the point is some contracts have provisions that require issuers meet certain financial tests. What happens if they violate them? Well, that's a technical default. If it's a serious violation, if your net worth or working capital is way below the specified level, the bondholder's representative, the trustee named in the trust indenture, could take legal action to force the issuer to do something to try to offset the adverse change in the company's financial condition. Maybe pledge assets as collateral, or maybe bump up the coupon payments of the bondholders to compensate for their greater credit risk. Or sometimes there's make-whole provisions, and that's one of the things I was just referring to, that might require a coupon be stepped up, increased under the happening of certain events. I've seen trust indentures that specify if a credit rating gets cut below a certain level on some issuer, that they'd automatically step up the coupon to a higher level as a way of compensating the investors for the greater risk implicit in the fact that the company now has a lower credit rating. And there's also negative or restrictive covenants. In other words, things you'd like to prevent the issuer from doing, because if the issuer took those action, that might undercut its ability to make all the debt service payments to the bondholders at a later date. So examples of such negative or restrictive covenants: there might be limitations on cash disbursements. In other words, limitations on the issuer's ability to pay dividends or to repurchase shares unless they meet certain financial tests. Or there might be restrictions on the company's ability to go out and acquire other companies or divisions of other companies, because most times mergers and acquisitions are financed by the company taking on a lot of debt to pay for that acquisition. And who gets the upside if the acquisition goes well? Well, the stockholders get the benefit. The only benefit to the bondholders of a successful acquisition is if the company's finances are stronger, it makes it more likely the issuer will be able to make all the debt service payments in full and in a timely fashion. But the bondholders share completely in the downside, because if the acquisition goes awry, that means the issuer might not be able to make the debt service payments in full and in a timely fashion. So bondholders have an interest in restricting the issuer's ability to make such sort of transactions. So let's look at a variety of different types of corporate securities. And remember what I had said previously. Oftentimes these structures, the specific features of a bond contract, are done for one of two reasons. Either to make investors feel that their investment is safer, that is, to allay their concerns about credit risk, or alternatively, to give the issuer more flexibility in managing its capital structure, i.e. making bonds callable. So first off, let's consider some of the issues that are structured in a way to reduce investors' concerns about credit risk. And that is that not many, but a certain percent of corporate bonds will be what are known as secured bonds. Well, two categories, secured versus unsecured, if we want to look at things from this perspective. An unsecured bond is a bond that is backed by the issuer's promise to repay. I'll say backed by issuer's promise. Now, in a general sense, the issuer's whole balance sheet, in effect, stands behind such a bond. But there are no particular assets that are pledged as collateral against individual bond issues. In effect, all of the issuer's assets back all of their liabilities, whether they're to bondholders or other holders of their liabilities, holders of their payables, as a for instance. Secured bonds, on the other hand, have two backings. They're backed both by the issuer's promise but in addition to being backed by the issuer's promise to repay, they're also backed by a pledge of specific assets. In other words, the company has identified certain pieces of real estate, certain operating assets, maybe securities that they hold, and they've pledged those particular assets as collateral on a given debt security, such that if the issuer defaults in terms of making the debt service payments in full in a timely fashion, the bondholders or the representative, the trustee named in the trust indenture, can actually take legal possession of those assets and sell them to recover as much as possible of the money owed to the investors holding these bonds that the issuer is no longer making the payments on in a timely fashion. So let's look at a couple of specific common types of secured bonds. So one type is mortgage bonds. Mortgage bonds are bonds that are backed by real estate assets of the issuing company. So understand, a mortgage bond is not the same thing as a mortgage-backed security. We'll talk about mortgage-backed securities later, but mortgage-backed securities, one of the categories of structured securities I'd mentioned earlier on around the introduction, these are sorts of securities where some party is going out and acquiring a whole bunch of credit instruments, in this case individual mortgage loans, and it's as the borrowers, also known as the mortgagors, make payments on their loans, those monies are collected and then dispersed to the investors in mortgage-backed securities. Well, that's a mortgage-backed security, and what we're talking about here are mortgage bonds, not mortgage-backed securities. So mortgage bonds are types of corporate bonds where the issuer can pay off the debt, interest and principal, out of any source of cash flow to the corporation, operating cash flows, asset sales, security issuance. It's just not coming from a pool of mortgage loans. But what makes it a mortgage bond is the company has pledged specific real estate assets, property that the company owns. Might be raw land, or it might be raw land, or I should say land that's developed and has buildings on it. And so in such a case, if the issuer fails to make the interest payments in a timely fashion on a bond, the bondholder's representative can possess that real estate, take possession of it, and sell it to raise as much money as possible out of what's owed to the investors. On the other hand, there are also equipment trust certificates. Equipment trust certificates are typically backed by operating assets. That is, assets a company is using to actually conduct their business and generate revenues. So these sorts of securities tend to be issued by airlines, which pledge their airplanes, railroad companies that are pledging their rolling stock, boxcars, locomotives, flat cars as the case may be, and trucking companies. You know, the major over-the-road haulage companies. The big tractor trailer rigs that move around loads of bulk goods and electronics and things like that. Well, these sorts of companies pledge their operating assets. The twist here is the legal title to these assets is actually held by the trustee representing the bondholders. So that makes it very easy for the trustee to legally take possession of these things. And you'll note the assets I described are very mobile, so they can be easily moved around the country, or for that matter, in many cases, around the world. And since there are many companies in these businesses that use the same or similar assets, we can take them away from the defaulting issuer and likely find a ready market from other companies in the same business, whether it's in the domestic market or in some other national market. But that again makes these considered very attractive because of the attractiveness of the collateral, as long as those industries are in reasonably good condition. And consequently, equipment trust certificates will tend to trade at relatively attractive yields. And by the way, that legal ownership of the operating assets only reverts to the company once the bonds are paid off in full. And in the case of collateral trust bonds, well, these are securities that are backed by, these are bonds, I should say, that are backed by securities that, as the name implies, are held in trust. So these are securities owned by the issuer of the bond, that wants to borrow money by issuing bonds, but then to reduce the borrowing cost, they pledge the securities they own as collateral. So if they default on the bonds, again, the bondholders can take possession of those securities to sell them to recover as much of the original amount of the debt as possible. Now, these are not the only types of secured bonds. Anytime a company pledges specific assets as collateral on a given debt issue, that's going to make it a secured bond. It's just that these are some of the more common types of secured bonds. But probably the majority of bonds are unsecured. And in the U.S., unsecured bonds are referred to as debentures. Now, you might wonder why the question mark there. Well, this is an issue more generally that one has to be sensitive to. Terminology is not universally consistent around the world. So oftentimes when you move from one financial market to another financial market, the same word has at least a slightly different meaning, sometimes a completely different or even opposite meaning. And that's the case with the word debenture. Because in the case of the US, debenture means unsecured. Guess what debenture means in the UK? It means secured. So you have to be very careful whenever you're dealing with colleagues or clients or associates that normally operate in a different financial market than the one in which you're used to operating, because sometimes the same word can mean at least something a little bit different than what it normally means in conversation when you're talking with your normal associates. But in some cases it can have a very dramatically different meaning, in some cases the exact opposite meaning. But in the U.S., debenture means unsecured. So naturally, that means that while the issuer has an obligation to pay, the bondholders don't have any claim against specific assets of the company. And there's not only debentures, there are also what are known as subordinated debentures. That is an unsecured bond that's been designated as subordinated, i.e. junior, to all other liabilities of the company. Now you might wonder, why would anyone in their right mind ever willingly buy a bond that puts them at the end of the line of creditors? Now mind you, even being at the end of the line of creditors means you're still ahead in the line of the equity holders, the preferred and common stockholders, that have even a less senior claim than that of the subordinated bondholders. But usually investors don't buy these bonds because they're subordinated. They usually acquire them for some other reason. Either these bonds were issued as part of a reorganization on bonds the company had previously defaulted, and the holders of those previously defaulted bonds get stuck with these subordinated debentures as part of the restructuring. Or another common circumstance is there might be some other feature of the bond that makes it so attractive, investors are willing to accept subordinated status to have access to that other feature. In fact, to illustrate that concept, one of the types of bonds we'll talk about in just a few minutes, what is known as convertible bond, is very attractive to investors because it gives them the better of two outcomes. And we'll talk about that later, so I won't go into it now. But given that the investors get the better of two outcomes, and note they get to pick them not before the fact when they have to guess at which of the two is going to be better. They don't have to select until the very end of the life of the security when they know which of the two outcomes is going to be better. Well, of course, investors find getting to pick the better of two outcomes very attractive, so most of the time issuers can make convertible bonds or issue them as subordinated debentures because they know investor demand is so high for such securities that they're willing to accept subordinated status to have access to that other feature. Now, just to put this in context, note that one of the issues to take into account is that there is a priority of claims anytime there's a financial reorganization. So if we look at the priority of claims that various investors would have in the case of a company bankruptcy or other organization, if we consider just the holders of the company's obligations, at the top of the heap would come the secured lenders or secured bondholders, because they've had specific assets pledged as collateral. After them would become the senior debt holders. That is the holders of debt that has been designated as senior to the other obligations of the company. After that would be the general creditors. And note, amongst the general creditors would be holders of the company's payables, but as well debenture holders, not subordinated debenture holders, but holders of regular debentures would be general creditors. After the general creditors would come the subordinated lenders. Again, holders of debt that's been clearly designated as junior to all other liabilities of the company. And it's only after all of the liabilities have been paid off, if a company is being liquidated, that you'd be able to issue any funds to the preferred stockholders. And only after the preferred stockholders had received their distribution, then and only then would any available monies be issued to the common stockholders. Now, I don't mean to say that any time a company gets into financial difficulty, there's a liquidation with everyone paid off at 100 cents on the dollar until all the money's gone, then no one else gets anything. Generally, the bankruptcy courts referee a negotiation between all the interested parties. And if you're more towards the top of the heap, you're going to get a larger percent of your claim paid off. And if you're towards the bottom of the heap, you're much likely to get a smaller percent of your claim if you receive any monies whatsoever. Let's start considering some of the other types of corporate securities. The first one we'll consider is convertible bonds. You might recall we've mentioned those in passing a few times. And I had talked about how they're in high demand on behalf or on the part of investors because they represent the opportunity to take the better of two outcomes once you know which of the two outcomes is going to be better. So you don't have to guess in advance. You can choose which of the outcomes you want after you know which is going to generate the better return for the investor. And because the investor gets to pick the better of two outcomes after they know which will be better, unsurprisingly, investors place high demand on such securities, which means issuers get to sell them at lower coupon rates than they'd have to set on otherwise similar non-callable securities. Non-convertible securities. So with convertible bonds, they're convertible into whatever the issuer says they're convertible into. So if we consider what sorts of securities or assets one might receive as a result of converting a convertible bond, most commonly those securities will be the same issuer's common stock. On the other hand, convertibles are convertible into a wide variety of things, whatever the bond contract says they're convertible into. So they might be convertible into that same issuer's preferred stock. Or they may be convertible into that same issuer's bonds, although usually it's convertible bonds that are convertible into convertible preferred stocks that are convertible into bonds. Or the bonds may be convertible into some other issuer's common stock. That type of convertible, by the way, is oftentimes called an exchangeable bond. An example of that would be once upon a time the IBM Corporation issued bonds that were convertible, but not convertible into IBM stock. They were convertible into common stock of the Intel Corporation. So when one issuer's bonds are convertible into some other issuer's common stock, it's considered a type of convertible, but oftentimes called an exchangeable bond. And in fact, you often have, not often, but you occasionally have bonds issued into various sorts of commodities. So you might have a convertible bond convertible into precious metal like gold or silver, or convertible into some energy like crude oil. Now, those commodity-based convertibles usually don't have a physical delivery feature. Normally, it's rather that the bond at maturity will be worth the greater of the par value of the bond or the market value of some number of ounces of gold or some number of barrels of crude oil. But by far the most common circumstance is where the bonds are convertible into that same issuer's common stock. So let's consider that circumstance. The terms of the conversion are expressed in terms of either a conversion price or a conversion ratio. And when you can do the conversion, again, is specified by the contract. Most convertibles are convertible from the time the bond is issued all the way until maturity, although many convertible bonds, or certain convertible bonds anyway, will be convertible only some certain period of time. I can remember an issue by American Airlines back in the 1990s. It was a 12-year bond, convertible for the first 7 years, but if you didn't convert by the end of the 7th year, you lost the right to convert. So sometimes the bond is convertible only over a portion of the life of the security, but most of the time it's convertible at any point over the life of the bond at the bondholder's option, all the way until the bond is matured or gets called. And note I said that the investor gets to choose the better of the two outcomes once they know which is the better of the two outcomes. Well, of course, that means the knowledgeable investor is likely to hold a convertible until the last possible minute. That is just the moment before the bond matures or just the moment before a bond is retired through a call. By which point you'll know whether you're better off accepting the call price or the maturity value or converting the bond into whatever it's convertible into, because at that point you're going to know which is the better of the two outcomes. Well, the conversion price or the conversion ratio are two different ways of expressing the same idea. That is, what are the terms under which the bond gets converted into whatever it's convertible into. We'll illustrate this with common stock. So there is both a conversion price, which to save time going forward, I'll just abbreviate CP. And let's say, for sake of example, that the conversion price on this bond issue is $25 a share. For the terms of the conversion to be consistent, if a bond has a conversion price of $25 a share, that would likely mean that it also has a conversion ratio. And again, to save time going forward, abbreviate that CR. Well, a conversion ratio consistent with that conversion price would be a conversion ratio of 40:1. That is, for each one bond, and by one bond that means $1,000 par value of the bond, for each one bond I decide to convert, I would receive 40 shares of the company's common stock. Now, these numbers aren't arbitrary, and I can show you how they are consistent with one another. Because the way you calculate the conversion price is by taking the par value and dividing that by the conversion ratio. Well, if I've got a par value of 1,000 and a conversion ratio of 40 shares for each bond I decide to convert, well, you'll note if you do that division, that's where the $25 per share comes from. And the 40:1 conversion ratio? Well, you calculate a conversion ratio by taking the par value of the bond again, but now this time dividing by the conversion price. So given that we're using a $1,000 par bond, and in this case we have a conversion price of $25 a share, well, if I divide 25 per share into 1,000, oh, guess what? That's where the 40 shares comes from. So the conversion price and the conversion ratio are always completely consistent with one another. They're just different ways of expressing the same conversion from alternate perspectives. But now let's dig a little bit further into this and consider what's the effective floor value of a convertible security. And the floor value, in effect, is determined by the bond's conversion value. That is, what is the bond worth not based on the future cash flows to the bondholder, but what is the bond worth based on the market value of the securities the bond is convertible into. And to illustrate the idea, let's say we're in a situation where we currently have a bond that's trading at, say, 80% of its par value, and simultaneously we have common stock of that very same issuer. And let's say the common stock is trading at $22 per share. Now, someone not knowing convertibles might say that, oh, well, the conversion price is 25, so why would I ever want to pay $25 a share for stock the market says is only worth 22? But that would be misunderstanding the terms of the actual conversion, because even though the conversion price is 25 per share, you're not paying $25 in cash, you're surrendering $25 of par value for each share that you're acquiring. So consequently, we don't know whether it makes sense to acquire this bond or not because we're not looking at it from the perspective of the conversion value. Well, if you take into account the conversion value, which you would calculate by taking the conversion ratio, again, the number of shares you get as a result of conversion, and multiplying that by the market price of the stock that you will obtain if you decide to convert the bond, Well, remember, the conversion ratio was 40 to 1. That is, I'll get 40 shares of stock for each bond I decide to convert. If I could sell each of those 40 shares for $22 a share, you'll note that would give you $880. And by implication, I'd have a huge risk-free profit, because if I could buy the bond for 80% of par, or $800, I could immediately convert the bond into stock and sell the stock for $880. That means I'd have a risk-free, what is also known as an arbitrage profit, of $80 a bond. Well, of course, you'd never see that in today's environment because the markets are so stitched together electronically. But back in the days when the bond market had to be discovered by getting on the telephone and calling dealers and asking them what prices they were quoting on bonds, you would occasionally find disconnects in price, that is, irrationally set prices, at least in terms of the value implied by the other related asset. So in fact, a bond should never trade for less than its conversion value. And based on the conversion value, this bond should be trading at least 88. And normally convertible bonds will trade at a premium to the conversion value. Why? Well, think of the advantages bondholders always have versus stockholders, or at least almost always have. One benefit bondholders always have, they always have a senior claim on the company's assets. Even if this is a subordinated debenture, and most convertible bonds, or at least a substantial portion of them, are issued as subordinated bonds, even if this is a subordinated bond, the subordinated bondholders are still senior in terms of the claim they have on the company relative to the common stockholders. And in addition to that, in the vast majority of instances, bond coupons, even the relatively low coupons in convertible bonds, will be higher than the dividend rate on the stock you're going to be able to acquire through conversion. So typically, bonds would trade at a premium to their conversion value. If the conversion value is 88, maybe the bond's trading at 94 to reflect those advantages of being a stockholder versus a bondholder. And you're not giving up future appreciation, of course, because if the market price of the stock goes up, that drives up the conversion value. Consequently, the price of the bond is likely to rise as well. And remember why issuers are likely to want to issue the bonds, because I didn't say this directly before, so let me say it right now. That attraction of having the better of two outcomes and getting to select which one you want after you know which is going to be the better means that convertible bonds can be sold at lower coupons than the company would have to set to sell a bond at par if the bond was non-convertible. In today's environment, if, say, a company could sell non-convertible bonds at par, say with a 6% coupon, so NCB for non-convertible bond, that means that same company could sell a convertible bond with the same maturity date with a coupon as low as maybe 2 3/4, and yet nonetheless be able to sell the bond at par. Why? Investors are willing to pay up for that privilege, or a more technical way of saying that, when you buy a convertible bond, you're not only buying the future cash flows in the bond, you're also acquiring a call option to buy the company's stock. And the lower the lower coupon on the convertible bond, or the difference between the coupons, you could look as the premium the callable bond buyers are paying to the convertible bond buyers are paying to acquire a call option to acquire the company's stock, which is what they're doing if they decide to exercise the conversion privilege. The last of the variations of corporate securities we'll look at today are what are known as preferred stocks. Now, preferred stocks are oftentimes considered equity securities, at least from an accounting and a legal perspective, at least most of the time. It turns out if preferred stock has a mandatory retirement provision, then even though it's what's called a stock, nonetheless you'd account for it as liability because the issuer has to retire it. But that's not true of most preferred stock. So most preferred stock, technically at least, is from a legal and accounting perspective considered an equity security. But in terms of how they behave as investments, they work a lot like bonds, as we'll see. Most preferred stocks have fixed dividend rates, just like most bonds have fixed coupons. Preferred stocks will have credit ratings from the credit rating agencies, where the agencies are rating the issuer's ability to pay that anticipated dividend in full and in a timely fashion. Just how credit rating agencies rate bonds and give them a rating that reflects the rating agency's assessment of the issuer's ability to pay the bond debt service in full and a timely fashion. Preferred stocks might be convertible, like bonds might be convertible. Preferred stocks might be callable, like bonds might be callable. So in terms of their investment features, preferred stocks are actually much more akin to bonds than they are to common equities. And so that's why we're talking about them here as part of the fixed income discussion. In fact, for an investor holding corporate preferred stocks, as part of a large diversified portfolio, the preferred stocks would not be considered part of the equity allocation. They'd be considered part of the fixed income allocation. So let's consider some of the features of preferred stocks. And the reason they're called preferred stocks is preferred stocks have several preferences. There's both a dividend preference and an asset preference. Dividend preference? Well, if the company is going to pay any dividends at all, they have to pay the preferred dividend up to the anticipated rate before they can pay any common stock dividends whatsoever. Note I said an anticipated dividend rate. So every preferred stock or preference share, another way of saying preferred stock, will have an anticipated dividend. It might be, say, called 6% preferred. That is because the anticipated dividend is 6% of some par value. So if we had, say, a par value per share of $50 par, well, 6% of $50 means the anticipated dividend rate is $3 per year, $3 per annum. Note, you could also call those $3 preferred stocks or $3 preference shares because you can express the anticipated dividend either as a percent of the par or as an explicit amount of currency units. Right? So the dividend preference, again, is the company has to pay the anticipated dividend up to the appropriate rate before the company can pay any common stock dividends whatsoever. And since preferred dividends, like common dividends, are typically payable quarterly, if I have an annual dividend amount of $3 per share, and that $3 per share is payable quarterly, that is in for equal increments over the course of the year, that means that the company would have to pay 75 cents on each of these 6% preferred stock shares before the company can pay any common dividend whatsoever. So that's the dividend preference. The company is going to pay any dividends at all. They have to pay the preferred dividend first up to the anticipated rate before they can pay any common stock dividends. The asset preference, well, we saw this earlier when we went through the priority of claims. The preferred stockholders come behind all of the creditors in any reorganization or liquidation. But after the creditors are paid off, the preferred stockholders would have to get their claim paid first before any money could be distributed to the common shareholders whatsoever. So you might ask, well, then why would anyone ever buy common stock? I'd rather have these preferences, the dividend preference and the asset preference. Well, the reason most individual investors don't want to own preferred shares is because we could refer to these as limited equity. That is, there's limitations on both the dividend preference and the asset preference. Yes, they have to pay the preferred dividend first if the company is going to pay any dividends whatsoever, but preferred shareholders can almost never get a dividend in excess of that anticipated dividend rate. So if the company turns out to be highly profitable, the only benefit to the preferred shareholders is greater certainty of getting that anticipated dividend rate. But there's seldom any upside in terms of a higher dividend, with one exception known as participating preferred, which is very uncommon. And again, there's a limitation on the asset preference. If the company is liquidated, no matter how much money is left over after you pay off all the liability holders, the preferred shareholders generally only have the right to claim the redemption value of the shares, which is typically equivalent to the par value. So given those limitations, preferred stocks are generally not attractive investments for most individual investors. But I should note, most preferred stock has features beyond those basic features of just the dividend and asset preference and the associated limitations. As it turns out, most preferred stock is what they call a cumulative preferred. In other words, if the company ever omits to pay one of these anticipated dividends, they don't just disappear. Ultimately, those omitted preferred dividends have to be made up in the future before the company could ever resume paying a common stock dividend. And as I said before, preferred stocks have many bond-like features, which is why we'll consider these more as fixed income securities than we'll think about them like common equities. Now, let's turn to another category of securities. Now, this is a completely different category. We're now going to talk about what I earlier referred to as structured securities. And the category of structured securities has three broad subcategories. That is mortgage-backed securities, asset-backed securities, and collateralized debt obligations all share certain features. Now, they're clearly different categories of securities, although we'll talk about those differences as well as the similarities. But there's a certain amount of structuring that goes into creating these structured securities. In effect, there's two different sorts of structuring. One is creating the pool of assets, the collateral portfolio, as it's called in some cases. In other words, the source of cash flow to be paid out to investors. So the first sort of structuring is oftentimes what is referred to as asset securitization. And what asset securitization means is you're acquiring a bunch of credit instruments, most commonly auto loans or credit card receivables or a variety of other sorts of things that might be securitized, home equity loans as a for instance. And what you'll do is you'll go out and get a bunch of those credit instruments. You'll acquire them from the lenders, or maybe the lender is actually creating this sort of security. And so they move those sources of cash flow, those credit instruments, because that's, again, usually what the source of cash flow is. And again, credit instruments are just the legal documentation that reflects an agreement between some borrower and some lender. And again, it might be mortgages, might be boat loans, might be credit card receivables, might be auto lease finance agreements. Those are sold by the original lender to a special purpose vehicle that's been created for this purpose. And then once that's created, you're selling units of investment to investors. So that's one sort of structuring, is creating the source of cash flow ultimately paid out to investors. Now, the initial such structures were typically very simplistic structures, structured as what are referred to as pass-throughs, which meant every investor was getting a proportional share of each and every dollar that came through the structure. So each investor would get their proportionate share of any of the principal being distributed, and each investor would get their proportionate share of any of the interest being distributed. So if I had a 10% interest, I was getting 10% of the interest, 10% of the principal. If I had a 2% interest, I was getting 2% of the interest and 2% of the principal distributed to investors. But as it turns out, we would like to be able to create a differentiated group of investments that might be supported by this asset securitization. So, maybe 10 or 15 years after the first asset securitization, mortgage-backed securities in the early 1970s, and at the time they were all structured as pass-throughs, by the early 1980s, 82, 83, they started structuring the payouts as well. So rather than paying a proportionate distribution of all interest and principal to all investors in the structure, we started slicing and dicing the cash flows and paying them out on a prioritized basis. And that structuring of the payouts meant that the investment was broken into some number of tranches, that is, different classes of investments, so that each of the tranches, while being supported by the same source of cash flow, there was different priorities in terms of getting their principal returned, different rates of interest, and various other different features that would be associated with the different tranches issued against a single pool of assets. Let's look at the two sorts of structuring that I talked about that are going to show up in different types of structured securities. So you remember the first sort of structuring, and this started back in the early 1970s, was over time came to be called asset securitization. And what that is generally a reference to is creating a pool of assets, sometimes called an asset portfolio or a collateral pool or a collateral portfolio, that is, in effect, a pooling of the credit instruments we talked about before that then become the source of cash flow to investors in these sorts of structured securities. So the asset securitization, well, the basic building block is created when there's a loan by some lender or loan originator to some borrower. Now, again, this credit instrument could be a mortgage loan, it could be an auto loan, it could be a credit card receivable, it could be a home equity loan, a wide variety of credit instruments have been used as the source of cash flow to pay out to investors in structured securities. Now, of course, this doesn't have to turn into a structured security. If the originating lender decides to hold that credit instrument as an interest-earning asset, well, that's as far as it goes, and there is no security created. But for a variety of reasons, both in terms of managing the risk of their balance sheet, in terms of increasing income, or in terms of reducing their borrowing costs, increasingly you saw more and more lenders selling those credit instruments into some sort of securitization to do what? Well, get money back, make another loan. Sell it, get the money back, make another loan. And again, the reasons for those sales are many. It could be a way of managing the risk of the balance sheet, could be a way of increasing the opportunity for fee income, because the more loans you make, the more origination fees you can make. And it might also be a way of reducing borrowing costs, because if investors find these things attractive, by securitizing a bunch of your credit instruments, loans, receivables, whatever, it might reduce the company's borrowing cost. So for a variety of reasons, they would put these credit instruments into some sort of legal entity. You could be organized as a trust or a corporation. They're generically referred to as special purpose vehicles. That's what the SPV is referenced to, because we're creating this legal entity for the express purpose of creating this structured security. And then once the trust or corporation was put together, the special purpose vehicle was properly created and executed, you'd sell units of interest to investors, so they'd have to pay money for their interest in that securitization. But then once the securitization was completed, we've got this trust formed. And again, that trust is going to hold the credit instruments that resulted from many loans made by many different originators, or possibly one originator making loans to many different borrowers. But ultimately, the loans from all these borrowers, reflected in terms of the credit instrument originally held by the originating lender, but then sold onto the trust account that investors bought an interest in. Now, as these borrowers are making payment on their credit instruments, they're making payments of interest and principal, that money gets passed on to the trust, and ultimately the money gets paid out to the investor. So on all of these structured securities, the primary source of cash flow to the investors are payments being made on loans or credit card receivables or a variety of other things, but that accounts for most of these things. As the borrowers make payment of interest and principal on their loans or other obligations, that money gets passed through the trust on through to the investors. Now, if we look at that in a bit more detail, let's actually consider the detail as it applies to different sorts of structured securities. So you'll note that the first type of structured security we'll talk about in detail are mortgage-backed securities, because this is the oldest of the sorts of structured securities out there. Mortgage-backed securities, again, being initially created in the early 1970s. You didn't see asset-backed securities until the early to mid-1980s. And the first collateralized debt obligation wasn't issued until 1987. So let's look at them in sequence. So we'll first talk about mortgage-backed securities. Although note, mortgage-backed securities and asset-backed securities are extremely similar to one another. In fact, the only difference is mortgage-backed securities are based on a pool of mortgage loans, or asset-backed securities are based on a pool of some other type of loans. Auto loans, auto lease finance transactions, credit card receivables being some of the more prominent ones. Actually, home equity loans are not considered mortgages, so securitizations of home equity loans are considered asset-backed securities. So really, the only difference between the two is the nature of the underlying loan. In fact, in many financial markets, mortgage-backed securities are simply considered a type of asset-backed security. It's primarily in the U.S., although in a few other places as well, that mortgage-backed securities are considered a different asset class. Why? Well, in the U.S. and a limited number of other places, mortgage-backed securities, at least the majority of them, have some special government or agency guarantee. And the safety that's presumed to come along with that government or government agency guarantee causes those securities to be extremely safe from a credit risk perspective, which is why in the U.S. and a few other places, mortgage-backed securities are considered a completely different asset class. Although in many financial markets, as I said before, mortgage-backed securities, absent a government or government agency guarantee, is considered just another variation of mortgage-backed security, differing by the nature of the underlying loans. And remember, I said the initial securitizations were really forming just pass-through securities, which we'll illustrate in just a few moments. And the reasons for the growth in the market? Well, it's the things I'd cited earlier. It gives the lenders a lot of flexibility. They can manage the risk of their balance sheet, increase their opportunity for fee income, or generate lower borrowing costs by creating a structured security as opposed to issuing a regular corporate bond. And as far as the size of the market, pretty huge. If you look at the U.S. context, mortgage-backed securities represent nearly a quarter of the securities outstanding. It's about the same size as the corporate bond market and just a little bit smaller than the U.S. Treasury market. Now, if we consider some of the details of mortgage-backed securities, of course, the underlying source of cash flow, the credit instruments I was referring to before, is of course an individual mortgage loan. Now, mortgage loans have many different structures. Sometimes they're interest only. All one has to pay is the interest due on the loan until maturity, when all the principal comes due. Or it might be a balloon loan. You're making relatively small payments for 5 or 7 or 10 years, and then all the unpaid principal comes due. But the vast majority of mortgage loans are fully amortizing mortgage loans. So in other words, the mortgagor is obligated to make the same monthly payment month in, month out over the life of the loan. Now, the proportion of that payment that's interest or principal varies over the life of the loan, but the amount due month by month is exactly the same. So that's by far the most common type, the fully amortizing mortgage. And you can have mortgages on residential or non-residential property, although securitizations of non-residential property loans would typically be referred to as a CMBS, commercial mortgage-backed security, whereas most of the mortgage-backed securities investors are acquiring or investing in, we could be more specific and refer to them as RMBS, residential mortgage-backed securities. And some of the terminology you'll encounter in the context of mortgage-backed securities, you'll hear some discussion of conventional versus other types of loans, here called non-conventional. But a conventional mortgage is any mortgage originated outside of a government mortgage loan program. So there's various mortgage loan programs run by the U.S. government, FHA loans, VA loans, RDA loans. I won't bother to go into the details on those. But those sorts of loans are one category, what we're here referring to as non-conventional. But any loan that's not originated through, or in other words, is originated outside of one of those government mortgage loan programs, is what you consider a conventional mortgage loan. And mortgages can be referred to as conforming or non-conforming. Conforming, that means the loan conforms with the underwriting guidelines of one of the U.S. mortgage agencies, Fannie Mae or Freddie Mac or Ginnie Mae. And such agencies could only securitize loans that conformed with their underwriting guidelines, why they're called conforming loans. Now, many loans are non-conforming. Doesn't mean they couldn't be securitized. It simply means they couldn't be securitized as part of an agency securitization. So, for instance, agencies could only securitize prime mortgages. Now, I'm sure many of you have heard of problems with subprime mortgage securitizations, and in fact, there were many problems with subprime mortgage securitizations. But guess what? Those were not securitized by the agencies. All those subprime mortgage securitizations were what are called non-agency securitizations. Or the government wants its programs to be seen to be primarily benefiting the middle class and lower income classes. They don't want their programs to be seen as benefiting primarily the wealthy, the well-to-do, and the upper income middle classes. So there was a size limitation. So loans beyond a certain size, what are called jumbo loans, were not conforming. Jumbo loans can be securitized, but only in non-agency securitizations, again because they were non-conforming. If we consider the primary risk factors and the returns to investors in mortgage-backed securities, at least in the vast majority of instances, mortgage-backed securities are extremely safe from a credit risk perspective. And that can be true either because you're acquiring a bunch of very high-quality mortgages, mortgage loans made to very credit-worthy borrowers under very strict guidelines and so forth. Or the other possibility is the mortgages are okay, but they're backstopped by some really strong guarantee, a government or government agency guarantee, or some other sort of credit enhancement. And so in those sorts of instances where credit risk is relatively inconsequential, the big risk is not whether you'll get your principal back, because it's going to be either paid back by the borrower, or if the borrower defaults, made good by an agency guarantee or some other form of credit enhancement. So it's not a question of whether or not you'll get your principal back. It's more a matter of when you're going to get your principal back. So the big risk with the vast majority of mortgage-backed securities results from the embedded optionality that we had referenced earlier. And in this context, it's different than the sort of call provision we talked about that you oftentimes encounter in corporate securities. But rather, remember, what we have is a source of cash flow that results from pooling or securitizing a bunch of mortgage loans. Each of the individual borrowers, each of the individual mortgagors has the right to fully or partially prepay the mortgage loan each and every period. And understand that that embedded optionality, which we could also refer to as an uncertain average life, well, the uncertain average life is going to change in a way that we know is likely to work adversely from the investor's perspective. Why? Well, guess who holds the option to prepay? The borrower. And naturally, the borrower is only likely to prepay when they find it in their best interest to prepay, which likely coincides with a time which is adverse to the best interest of the investor. Because think about that. If we've got a mortgage loan upon which the borrower is paying, say, a 4.5% rate of interest. So that's the mortgage rate, I'm presuming. So if the mortgage rate, that is the interest rate we're paying on the mortgage loan, or the borrower is paying on the mortgage loan, is 4.5%, when would they consider prepaying? Well, note, if mortgage rates rose to something like 6%, naturally you as the investor would like to get your money back out of that old 4.5% investment as rapidly as possible, because you'd like to reinvest the money at 6% as soon as possible. But of course, if interest rates rise, that's exactly when the borrower is going to pay off the loan as slowly as possible, because a 4.5% loan represents cheap financing if the current market rate of interest is 6%. So exactly when you'd like to get your money back sooner, the average life of the investment is likely to lengthen out as borrowers act to optimize their own circumstances and take advantage of that low borrowing rate for as long as possible. Conversely, if mortgage rates had fallen from, say, 4.5% to maybe 3.5%, so that's the new mortgage rate, well, of course, as an investor, you'd now like to be earning that 4.5% as long as possible. But guess what? With mortgage rates that much lower, existing borrowers have the incentive to go out and borrow anew, that is, refinance their mortgage at that new lower rate and use the proceeds of that new borrowing to pay off that pre-existing mortgage loan. In other words, they're prepaying, which accelerates the return of principal to the investors. Consequently, exactly when you'd like your investment to last as long as possible, the repayment of principal is likely to be accelerated. This is what's known as prepayment risk. And prepayment risk pretty much is certain to work against the best interest of the investor. If rates go up when you'd like your money back sooner, the average life is likely to lengthen. On the other hand, when rates fall and you'd like to leave your money invested for as long as possible, the prepayments are likely to accelerate. And in some periods of time, when interest rates fall dramatically, you'll get your money back very, very rapidly. On average, if rates were stable, if you had a pool of 30-year mortgage loans, it might be 12 or 13 or 15 or maybe 17 years before half of the principal was paid off on the existing loans. But if there's a significant decline in interest rates, which happens periodically, where rates will drop 100, 150, 200 basis points in a period of a few weeks or a few months, well, that naturally opens up huge refinancing opportunities for loans taken out previously. And there have been some instances where, after significant declines in rates, mortgage securitizations that occurred just before that decline in rates, where investors, not knowing better, might think that if they invest in a pool of 30-year mortgages, they won't get their principal returned, or at least half of it returned, for 12 or 15 or 17 years. In some cases, after a significant decline in interest rates, as much as half of the principal will be returned in the very first year. And think about how bad that is. Not only are you not earning the old higher interest rate you were earning before you got that prepayment, you've got all this money back, and now what are your reinvestment opportunities? The very low rates that drove the refinancing means you're facing very unattractive reinvestment opportunities. So that's the big risk with high-quality mortgage securitizations. Not that you won't get your money back, but rather that the average life is likely to change in a way that's adverse to the investor's best interest. And again, that unique risk, there's a variety of ways of referring to it. They'll talk about it as prepayment risk, or they'll talk about the uncertain average life of the investment, or you can also refer to that as the embedded optionality that we talked about previously. So the first type of mortgage securitization that started occurring in the very early 1970s, in fact 1970 is the exact year that the first Ginnie Mae securitization occurred, Freddie Mac in 1974, Fannie Mae in 1981. Well, there's first the securitization where the loan between the borrower and lender gets securitized, put in that special purpose vehicle. The mortgage loan pool can be called generically, but it's typically organized as a guarantor trust. And then to get their interest in that security, the investors have to pay. But then once the securitization has occurred, as the individual borrowers make payments on their loan, typically mortgage loans are amortizing loans, so every monthly payment is part principal and part interest. That gets paid into that special purpose vehicle, which now is the legal owner of the mortgage. And as they collect the money, it gets dispersed to the investors. And remember how I described the workings of a pass-through security. Each investor in the security, in effect, gets their percent participation, their pro rata share, their proportionate share of each and every dollar that goes through the structure. So if every dollar of repayment of principal, whether it's paid on time or prepaid, if the entirety of the securitization was invested in by only two investors, investor A buying a 60% interest, investor B buying a 40% interest. Now, I'm just talking conceptually because they express these interests in terms of an original face amount and a factor that expresses what percent of the original face amount is still outstanding. So this is just talking about it from a conceptual perspective. But if A and B bought those respective shares of the pool, that means investor A would get 60% of all the principal being distributed, whether it was paid on time or prepaid by the borrowers, and investor B is going to get 40% of all the principal being paid out, again, whether it was paid on time or prepaid by the borrowers. And they're getting exactly that same pro rata share of the interest as well. Now, when you have that pass-through sort of structure, that means that it's undifferentiated risk because each investor is getting their proportionate share. Well, we might like to create investments that have features that are differentiated, that might have different characteristics on different types of securities from the same issue that might cause the different securities to represent a more attractive trade-off between expected risk and return from the investor standpoint. So remember I talked about structuring the payouts, the distributions to investors. Well, in the mortgage-backed securities market, that started happening in about 1982 or 1983 when they started structuring the payouts. You might remember I said as we get the cash flows off the collateral, rather than pay them out proportionally the way we do in a pass-through security, we're going to slice and dice the cash flows and pay them out in some prioritized fashion. So rather than all investors getting a proportionate share, it is likely all of the investors will be earning some interest, although not all. There are principal-only strips which only get a share of the principal. But most categories of these investments will get some share of the interest income, but different classes of securities will be getting different rates of interest. And we're clearly not going to be returning principal to all investors simultaneously in a CMO the way we do in a pass-through. Because CMOs, or collateralized mortgage obligations, were the type of mortgage securities, mortgage-backed securities, where we were structuring the payouts. And so when it comes to returning principal, rather than all investors getting some share of the principal, we're generally going to direct all return of principal only to a single tranche at a time, and the principal will be returned according to some pre-specified priority. So unlike an investor in a pass-through, where you're getting a share of the principal each and every month over the entire life of the mortgage pool, in the case of CMOs, we're generally going to direct initially the principal only to be returned to the investors in the tranche designated to get its principal back first. Only when that tranche is retired in its entirety would we then start returning principal to the investors in the tranche to get its return of principal second, and that would be the only tranche to get return of principal until that tranche was retired in its entirety. Then we'd start returning principal to the investors in the next tranche. So investors and CMOs can self-select into where they want to be in the queue. They want to be at the front of the queue, in other words, have a relatively short-lived investment. They want to be at the back end of the queue, having a relatively long-lived investment, or they're likely to be somewhere in the middle. But that way, investors can select a class of investments that has an expected life that's relatively consistent with the investment views and other constraints under which the investor is operating when making their investment selections. And the simple sort of structure I was just describing, which returns principal in sequence to investors in the various classes of bonds, those are called sequential pay CMOs. Let's take a look at a diagram that tries to illustrate the concepts I was just talking about on a CMO. And I defined the word in more detail earlier in the program, but I used it in the last moments of the discussion, and that was tranche. Now, tranche is a French word that literally translates as slice. So a tranched investment means that rather than, like in a pass-through, all investors are acquiring basically the same security, each tranche in a CMO, and note nowadays nearly all asset-backed securities and all collateralized debt obligations are tranched in a similar fashion. Well, each tranche is a unique investment. Yes, the source of cash flow is the same for all the tranches in the same deal, but each of the tranches will have separate terms, possibly different interest rates, although some of them might have the same coupon rate. But there's clearly a differentiation in terms of the priority for returning principal. And in agency CMOs, that's CMOs based on U.S. agency mortgage-backed securities, it's a straight time-based priority. So as borrowers make payments on the loans that have been securitized, we're collecting all that money and we're going to pay it out as return of principal or interest payments to the investors in the various tranches. But remember, in a CMO, rather than paying the money out proportionally to all investors, in general, we're going to pay interest to most of the tranches, but principal will be directed only to the tranche that's currently supposed to be the one having its principal returned, which is initially the shortest term outstanding tranche, tranche number 1 in this example. So as we're collecting cash flows on the securitized loans, yes, we're paying interest on all of the outstanding tranches, but note how I've got the diagram set up here. In a CMO, the designation of something as interest or principal as it's part of the payment by the borrower, those categories in effect are wiped away and the money is categorized anew. So of all the cash we collect on the securitized loans, we'll pay the contractual rate of interest, that is the coupon rate times the currently outstanding principal amount. We'll pay the contractual rate of interest on all of the outstanding tranches, but then any money that's left over, regardless of whether we received it as a payment of interest or a return of principal, any money left over after we pay the contractual rate of interest on all of the outstanding interest-paying tranches, any money left over we'll use to return as much principal as possible to the shortest term outstanding tranche. And that'll be the only tranche to receive return of principal until we return the last dollar of principal owed to them. Then and only then do we start returning principal to the investors in tranche 2. And that's going to be the only tranche to receive return of principal until they get back every last dollar of principal owed to them. Then and only then do we finally start returning principal to the investors in tranche 3. So you might remember in the last exhibit I referred to this sort of structure as a sequential pay CMO, or more technically, it's a CMO made up of sequential pay tranches. Well, of course, they're called that because the principal is returned in sequence. Now, there are many other types of tranches and CMOs, whether they're agency or non-agency. And a detailed discussion would be way overboard for the time we have to devote to this topic, but just to make you aware of some of the variations. Z-bond tranches, they're also called accrual bond tranches, and that's a more descriptive name. Or sometimes they're just called accrual bonds. Such tranches don't actually receive the interest payment in cash. Rather, the interest payment is reflected by a step up in the face amount of the security by the interest earned but not paid. Now, is that a good or a bad thing? Well, it depends, like the answer to most tough questions. It depends on how interest rates are moving. But the point is, investors in these Z-bond tranches have no reinvestment risk, at least initially, because the interest they're paid is not being given to them in cash, which they then have to reinvest somewhere else. The interest they're earned is reflected by an increase in the face amount, earning the same interest rate that was paid originally. So they avoid reinvestment risk until all the shorter dated tranches are retired. Or PAC bond tranches. These are probably the safest of all CMO tranches because, as the name implies, there's an amortization schedule. So investors in such a tranche aren't guaranteed their money will be returned according to that schedule. But once you're in the window, that is, once you're in the time frame over which this amortization schedule is supposed to be paid off, the investors in the PAC bond tranche, in effect, go to the front of the line. They get their principal back first, at least up to the amount that is scheduled to be returned, even if there are shorter dated tranches still outstanding. Or there's targeted amortization classes, which is a variation of the PAC bond tranche, just not quite as much protection built into the structure. And there's a wide variety of structures. There's floating rate tranches. There's inverse floating rate tranches. And as the name implies, floaters, well, interest rates generally go up. The coupon rate on the floating rate tranches rise as well. Rates go down, the floater would see its coupon rate go down. Inverse floaters are just the opposite. The coupon rate on the inverse floater is moving opposite the direction of the change in interest rates. So there's a wide variety of different sorts of tranches that can be created. And remember, what I said was one of the primary purposes of structuring the payouts. We can create a wide variety of differentiated investments that will have characteristics that appeal to a broader spectrum of and different types of investors that might be attracted into a pass-through security. In fact, this structuring of the payouts was so popular and could create securities that had relatively more attractive features that while when the first asset-backed securities were created in the mid or so 1980s, they were structured as pass-throughs, the structuring of the payouts and the benefits that conveys that I talked about before are so great that nowadays just about all asset-backed securities have the structured payout and are never structured as pass-throughs. Pass-throughs, in fact, are only common in the U.S. agency mortgage-backed securities market. Now, moving on to other sorts of asset-backed securities. Remember, asset-backed securities are very similar to mortgage-backed securities. The only difference is there's at least one and possibly two. One is that the nature of the underlying instruments will be different. Mortgage-backed securities are only based on pools of mortgage loans, whereas asset-backed securities, the most common types, are based on home equity loans, based on auto loans or auto lease finance transactions, credit card receivables, so things other than mortgages. But beyond that, the structures are very similar. The one other big difference, of course, is that at least for agency mortgages, agency mortgage-backed securities, you have either a government or a government agency guarantee. With asset-backed securities, you don't have that similar sort of protection. So when we're analyzing an asset-backed security, you have to consider what is the source of the cash flow, because obviously the nature of the underlying instrument will have some impact on the expected life. The typical auto loan is 5 to 7 years in length, so auto loan securitizations are not going to have anywhere near the life as long as a mortgage-backed security. Credit card receivables have their own unique characteristics that we'll talk about later, but unlike most of the other securitizations, that's the one type of asset-backed security where you end up keep replenishing the pool of credit instruments, because credit card receivables have a very short life. The average credit card receivable is paid off in something like 1.5 years or thereabouts. the cost of building a structure that only had a year-and-a-half life would be relatively prohibitive. So consequently, they will structure these things so they have lives of closer to 5 years by, in effect, as the credit card receivables are being paid off, you'll take the returned principal and use that to buy more credit card receivables out to some designated life. And as far as the investment characteristics, in general, asset-backed securities have been extremely safe. In fact, if you look at the performance of most asset-backed securities since the aftermath of the fall of 2008, there have been more credit rating upgrades than downgrades when you're looking at things like auto loan asset-backed securities or credit card receivable asset-backed securities. And so the returns have been relatively attractive. Now, mind you, modest, because the vast majority of these have upper investment grade credit ratings, but they have performed as anticipated, as opposed to many fixed income securities that actually had relatively bad performance in the immediate occurrence and aftermath of the financial panic in 2008 and the ensuing financial problems in the immediate years and quarters thereafter. Outside of real estate related asset-backed securities, that is securitizations of things like home equity loans, the two largest sectors of the asset-backed securities market are the credit card account receivable asset-backed securities and the auto loan or auto lease finance asset-backed securities. So let's look at just a little bit of detail in regarding those two of the larger sectors of the ABS market. So I started to talk about some of the features of these asset-backed securities previously. Let's go into it in a little bit more depth. So with credit card receivables, typically the sponsoring organization is a credit card company. So like American Express or Capital One or somebody like that. Now, of course, that credit card company issues many credit cards, the users of which will then use the credit card to go clothes shopping, to buy a meal at a restaurant. Well, of course, the use of the credit card creates a loan because the credit card company is making payment on your behalf. You now owe money to the credit card company and will have to pay interest on that loan for as long as it's outstanding. Well, credit card companies used to borrow money to make loans to their customers by issuing bonds. They found out they could borrow more cheaply by issuing credit card receivable asset-backed securities. So off of the credit card company's balance sheet, where they have a bunch of credit card accounts receivable that are created as the card holders use their cards for various purchases, what they would end up doing is moving those credit card receivables off their balance sheet into a special purpose vehicle. So remember our discussion of special purpose vehicles previously. That's simply a legal entity we've created for the purpose of doing this asset securitization. So as those credit card accounts receivable, no, not from one client, but many accounts, literally thousands or tens of thousands of accounts. And then once that special purpose vehicle is legally formed, they'll sell units of interest to investors. And of course, investors have to pay to acquire their interest in that credit card receivable asset-backed security. But now as the holders of those cards make payments, the payments go to the special purpose vehicle and in effect get passed on to the investor. Now again, as I'd said a few moments ago, these credit card receivables typically have a relatively short life. So without over time throwing more and more credit card receivables into the structure, the structure would wind down and be wrapped up in a year, year and a half, or 2 years or something like that. Typically these things have a 5-year life, although it could be longer or shorter. So if we see the length of this timeline is 5 years, typically the first 4 years will be what's known as a revolving period. And in the revolving period, there's no return of principal. In the revolving period, the interest that's collected on those receivables will be used to pay the interest owed to the investors, but any principal that's paid by the holders whose accounts receivable have been put into the trust, in effect, principal that's paid back will be used to buy more accounts receivable to keep replenishing the sources of cash flow inside of that special purpose vehicle. And so that will happen for the first 4 years. It's only in the 5th year where they'll either start returning principal in some structures, or in other structures they'll be setting principal aside for all of it to be returned at the end of the 5th year. Now, another feature of these is what's characteristic of most accounts receivable. Well, specifically credit cards accounts receivable. Well, let's say initially the sponsor put in credit card accounts receivable of, say, I don't know, say $10 million. Say that vertical distance was I say, let's make it $100 million. And let's say this horizontal axis represents time. Well, what would be true if there was initial principal balance of $100 million on those accounts receivable? Well, think about how people pay their credit cards off. Some pay the balance in full every month. Some pay part of the balance, and so in some cases the monthly balance goes up when they make more purchases than payments made on the card. Other amounts, the balance will go down. In other words, the amount of outstanding principal would not be constant like it would on a typical debt security, but rather the amount of outstanding principal is likely to vary over time. Well, note, investors would find that relatively less attractive to not know the amount of principal upon which they're earning interest. So what's typical in these structures is investors aren't buying the whole deal. Investors are buying a portion of the deal, but the balance of the deal is actually kept by the sponsor. In other words, the credit card company itself. And all that variation in principal will impact the sponsor's interest, not the investor's interest. Now, if we say a few things about auto loan, and there's also auto lease finance, but to keep the discussion manageable, let's say I'll focus specifically on auto loans. Well, these days, most auto loans probably have terms from their origination of somewhere between 5 and 7 years. So clearly, these securitizations will be much shorter than the life of a typical mortgage-backed security, as most loans are 15 or, in fact, most are 30-year loans. So much shorter lives. And while auto loans will sometimes prepay, they prepay at a much more predictable rate than mortgage loans do. Why? Well, remember we talked about mortgage refinancing as one of the main sources of prepayment risk, which hits home really badly if there's a significant decline in interest rates. Well, do you see prepayments for the same reasons on auto loans? Almost certainly no. Why not? Well, what is one of the requirements of refinancing? You can seldom borrow more than the current value of the asset you're borrowing against. Most real estate, and this hasn't been true in recent years necessarily, but most real estate tends to appreciate over time. So you seldom have trouble borrowing the existing amount of the outstanding debt, because even if you weren't paying down the principal, as long as there's property appreciation, that means you'd be able to refinance the loan. But what's true of most auto loans most of the time? Or I should say, what's true of most autos most of the time? Auto values decline fairly rapidly. In fact, they typically decline more rapidly than the principal pay down on the loan you took out to buy the car in the first place. You'll sometimes hear people joke that as soon as you drive the car off the lot, it's 40% less valuable than just before you drove it off the lot. That might be a little bit extreme, but the point is any use of the car means it will be worth dramatically less than, at least in most instances, the manufacturer's suggested retail price. So it's very difficult to refinance loans here because typically the auto is less valuable than the amount of the loan. And there's a variety of other complications. Think of the size of most auto loans. Most auto loans are likely to be $10,000 or $15,000 or something in that range, as opposed to the hundreds of thousands of dollars that would be true of the typical mortgage loan. Well, when you refinance, what's the source of the benefit? It's not only the amount by which you reduce the interest rate you're paying, it's also the size of the loan upon which you're paying that rate of interest. Well, guess how much money you're going to save if you had a $10,000 auto loan and interest rates fell by 1%. Oh, you'd save about $10 a month. In other words, it's hardly even worth going through the trouble of refinancing, much less bearing any associated costs, given the minuscule savings. So yes, there are prepayments on auto loans, but the prepayments are driven by things like sales of autos or people getting in a crash or a wreck. Well, note those sorts of things are much more predictable in a statistical sense, which is why prepayment risk is not a big issue with auto loans. In fact, I looked at the performance of auto loan securitizations in the post-2008 era. And if you looked at the series of auto loan asset-backed securities originated in 2009 and looked at how their credit ratings were evolving over time, well, looking at the 2009 vintage, I think there was literally no credit downgrades on any of the tranches that were rated by, I believe it was Moody's that I was looking at the study that was done by. So, of course, many tranches had paid off between 2008 and 2011, but the tranches that were still outstanding, none of them had a credit rating downgrade, and a significant portion, more than half, had actually seen a credit rating upgrade. So in terms of the investment performance, both credit card receivable ABS and auto loan ABS have performed in a very sterling fashion, despite the financial travails being experienced in many financial markets around the world in recent years. The final category of structured security we'll talk about are collateralized debt obligations. And while that had been one of the fastest growing segments of the fixed income markets from the late 90s up until about 2005 or 2006, there was a dramatic fall off in the issuance of CDOs in the 2007-2008 timeframe. In fact, between 2007-2008, or in the year of 2007, there was a 90% decline in the issuance of collateralized debt obligations. And then in the year of 2008, there was another 90% decline. So over a period of 2 years, the issuance of CDOs dropped by something like 99%. Although in recent years the market has started to recover, although based around a specific type of CDO known as a CLO, a collateralized loan obligation. So in general, what's a collateralized debt obligation? It is a type of structured security that differs in significant ways from the MBS and the ABS we've talked about so far. And the two really significant differences. One is, in a CDO, you will not necessarily have a single asset class. All of the other structured securities we've talked about, once you have that asset or collateral pool or portfolio, what you're going to put in there is exactly all the same stuff. It's all mortgages and a mortgage-backed security. It's all auto loans and an auto loan ABS. It's all auto lease finance transactions and an auto lease finance ABS, et cetera, et cetera, et cetera. So in everything we've talked about before, there's a great homogeneity. All of the loans in the pool are against the same type of asset and have other similar terms in terms of time to maturity, interest rate, et cetera, et cetera. Well, with collateralized debt obligations, you can mix and match. I could mix bonds with loans. I could mix mortgage-backed securities with small business loans. So there's not necessarily only a single asset class. And the other big difference is in terms of the payouts. In most of the other structures we've talked about, once you pay the contractual rates of interest on all the outstanding tranches, any money left over gets directed to the tranche that's supposed to get its principal back first. In a U.S. agency mortgage-backed CMO, the money is returned on a time-based priority. In non-agency CMOs and the ABS we talked about, generally the principal is returned on a seniority-based priority. The senior-most tranche gets its principal back first, and only after the senior-most tranche gets its principal back, then will we return principal to the next senior-most tranche. And remember, principal is, what we're returning as principal is any money we have left over after we pay the contractual rates of interest. Well, therein lies another difference with CMOs, because as we make a payment of interest to the investors in the various tranches, when we get to the end, we're not paying to the junior-most tranche a rate of interest. Rather, they get all of the money that's left over. So in the early years of one of these structures, if performing well from an operating perspective, the actual payouts to the junior-most tranche might be 15, 18, maybe 22 or 25%. Now that sounds like, hey, sign me up for such an investment. Well, the other part of CDOs is that there's oftentimes a lot of credit risk associated with the assets in the loan pool. And to the extent there are loan losses, credit-associated losses on the credit instruments in the pool, those losses are not shared proportionally by the investors in all the tranches. Once we burn through any other credit enhancements, all of the credit losses result in a write-down of the principal of that junior-most tranche. So yes, the junior-most tranche gets all the excess cash flow, if there is excess cash flow, but that junior-most tranche also eats all of the credit-associated losses to the extent there are credit losses in excess of any other guarantees or such credit enhancements. Now, a bit of terminology. Sometimes CDOs, the acronym for collateralized debt obligations, can be referred to as CLOs. Well, of course, the L stands for loan. And this is the one type of CDO that has been making a bit of a comeback in recent years. Now, you also see what are sometimes called CBOs, that is collateralized bond obligations. The very first CDO back in 1987 was a structure made up of about 50-50 emerging market government debt and high-yield U.S. corporate bond debt. Like I said, they'll oftentimes mix and match different types of assets in the collateral pool. So if we look at the typical structure of a CDO, in fact, let's talk about the most common type, which is the CLO. And the CLO are usually organized as what would be referred to as balance sheet CDOs. And balance sheet CDOs are created by banks. Now, a bank, of course, has a balance sheet. And on the asset side of the bank's balance sheet, they would have a variety of assets. They might have small business loans, SB for small business. Or they might have prime corporate loans. I'll just write prime. Those are loans made to the largest, most creditworthy corporate borrowers. Oh, they might own mortgages. They might own treasury securities. Yeah. So you got a bunch of things on the balance sheet. Well, banks will use CDOs as a way of managing the risk or the capital requirements of their balance sheet. So if a bank wants to do a CDO, in fact we'll call it a CLO, a collateralized loan organization, the bank will act as sponsor in setting up a special purpose vehicle. Remember, the legal entity that's going to hold the credit instruments. Once the special purpose vehicle is put together, the special purpose vehicle will issue bonds to investors. And of course, investors have to acquire their interest by parting with money. Well, the bank's going to take that money, and in return, let's say this is going to be a CLO based on prime corporate loans. So in other words, those prime corporate loans have been moved off the balance sheet of the bank, and I'll just again write prime, but that's short for prime corporate loans. The loans made to the most creditworthy corporate borrowers are now literally owned by the special purpose vehicle. Now, one of the big issues here is what they call bankruptcy remoteness. In other words, you want to make sure all the legal niceties are observed so that this will be viewed as a true sale. Because, of course, if the bank ever gets in financial difficulty, the lawyers of its creditors are likely to say, oh, this is just a legal sham. The bank was only setting that special purpose vehicle up to move assets to a place where the bank's creditors could not lay hands on them. So the legal requirements in creating this separate legal entity have to be observed very precisely. But as long as all those legal requirements are observed, that bankruptcy remoteness will be achieved. So what's the bank's benefit from doing this? Well, from the bank's perspective, it allows them to alter the risk of their balance sheet. Now you might say, oh, gee, they're getting rid of some of their best assets. Well, yeah, but the safest assets oftentimes pay the lowest rate of interest. In fact, the first big period of creation in these CLOs was back in the early 2000s, the early noughties. And the primary purpose was, in fact, the banks were dumping these high-quality loans off their balance sheets because they wanted to free up capital to invest in riskier loans that would generate for them a higher rate of interest. So when I said banks will use these for risk management purposes, many times people mistakenly view risk management as risk reduction. Wrong way to think about it. Risk management is adjusting the risk of your portfolio or your balance sheet to the desired level, which might be less risky, or as in this case, might be a higher level of risk to generate higher expected returns. The other reason is capital management, because banks have to hold capital against their assets. Well, if you move assets off the balance sheet, that frees up capital to make new loans and thus generate new origination fees. So those are the primary reasons for creating this sort of structure. But then once the structure is put together, as those corporate borrowers pay on their loans, the money is forwarded to the special purpose vehicle and distributed to the investors. And the distribution is oftentimes illustrated through what they call a cash flow waterfall. And without going into it in excessive detail, we've got this source of money, the prime corporate loans in our example, and that's the funding we're using to pay claims to the various investors. Well, after paying our administrative fees and expenses and other legal obligations, we'll first return interest to the investors in the senior-most tranche. Well, if that bucket fills up and we still have money left over, it will spill into the next bucket. Let's say those are investors in the second highest rated tranche, the AA rated tranche. That bucket fills up, it'll spill over and start tipping into the next bucket, say the single A rated tranche. And so you're paying the interest due to the investors in the various tranches all the way down to the junior-most tranche. And let's say that junior-most tranche is a non-rated tranche kept by the sponsor itself. Well, all the money that's left over available for distribution as payment of interest to the investors, all the money left over at that point, in effect, is being paid to the investors in that junior-most tranche. And again, that might sound like a good deal, but this junior-most tranche is also the one that will eat the credit losses first. And so it's what they oftentimes refer to as the first loss piece. Any credit losses in excess of the other credit enhancements will not be shared proportionally by all the investors, but rather would be reflected by a dollar-for-dollar write-down of the principal amount of the junior-most tranche. In fact, there's a good chance that by the time the deal is unwinding, the investors in that junior-most tranche will get back pennies on the dollar or maybe get back no principal whatsoever. And while this was talking about the return of interest, principal is generally returned in a fashion similar to the other tranched investments we talked about outside of agency CMOs. That is, money is returned primarily on a seniority basis. The senior-most tranche gets its principal back first. Only after the senior-most tranche has gotten back all of its principal would you return principal to the second senior-most tranche. After they've gotten their principal back, then and only then to the third-most senior tranche, and so forth and so on. So the credit losses are coming from the bottom up. The return of principal is going from the top down. The last type of CDO we'll look at is what's referred to as a synthetic CDO. And they picked up a lot of bad press as a result of the financial crisis and the aftermath. But just so you're aware of what a synthetic CDO is in case you encounter the term, because some of the ones created a while ago are still out there trading, and I'd be shocked if they don't make a comeback at some point in the relatively near future. And the key characteristic of a synthetic CDO is how the investors get exposure to the risky asset class. Because if you remember the diagram I had drawn just a few moments ago showing that collateralized loan obligation, where the bank acting as sponsor set up a special purpose vehicle, and then the bank was moving the prime loans off of its balance sheet into that special purpose vehicle. So the assets were going off the bank's balance sheet and now held by that special purpose vehicle. So as the borrowers made payments on the loans, that was the source of cash flow to make payments to the investors in the CLO, or as I called it before, the balance sheet CDO. Because all CLOs that have been created so far have been of that sort called balance sheet CDOs. But in a synthetic CDO, it's a little bit different. So again, we have a bank that's going to act as sponsor in terms of setting up that special purpose vehicle. But now, rather than sell the assets for a variety of reasons, banks will decide to keep those assets. But what they will do is they will enter into a credit default swap, where, in effect, the bank becomes the protection buyer. That is, they're the buyer of credit protection. The special purpose vehicle becomes a protection seller. That is, they're selling credit protection. And so what that would mean is the bank would have to pay the equivalent of an insurance premium, although in this case the terminology of the credit default swap business is they'll pay the CDS spread. That's simply the payments that the buyer of credit protection has to make to the seller of credit protection. And what will the bank, the buyer of credit protection, get in return? Well, we don't know, because it depends on whether or not any of the events insured against, like failure to pay or the declaration of bankruptcy, actually occur. If none of those events actually occur, then you never collect on the equivalent of the insurance policy here. So you'll note the bank hasn't moved the risky assets off the balance sheet, but the way most bank regulators would view this is as long as the bank has bought the equivalent of insurance or this credit protection on those risky assets, the bank will not have to hold anywhere near the same amount of capital against that asset. So from a bank capital requirement perspective, buying credit protection is basically equal to having to sold the loan in the first place. Now, there's a variety of reasons why banks do that, and this is not the place to go into all the detail. What I wanted to focus on here is what is the key characteristic of a synthetic CDO. And the key characteristic is just what I was talking about. A synthetic CDO means that the investors who are investing in the special purpose vehicle are not getting exposure to the risky asset by owning the risky asset, but rather they're getting exposure to the risky asset class and therefore receiving these CDS payments that reflect the risk of the asset they're getting exposure to, but they're now getting that exposure synthetically by selling credit protection. So that's the key. What is the key characteristic of a credit default swap? Is a of a synthetic CDO, is a synthetic CDO will always contain a credit default swap. That then being the key characteristic of those synthetic CDOs. Now, moving on briefly to a few other sorts of asset classes, because the ones we've talked about already, government debt, corporate debt, and the structured securities, those sectors of the fixed income market, depending upon which market you're talking about, US, UK, Japan, whatever, the types we've talked about already probably account for somewhere between 60 and maybe 80% of the outstanding fixed income securities in most of the major financial markets. But there are some other important segments, and we'd like to touch on those at least briefly. So one significant asset class we haven't talked about, other than mentioning and passing a few times, are money markets or money market instruments. And another way of referring to the same thing, if you're working in the asset management business, you might refer to these sorts of things as cash equivalents. In other words, what we set up here, short-term, high-quality debt securities. So generally what makes something a money market instrument is it has a short time to maturity from issuance. Generally, that is less than or equal to 1 year from the date of issuance. These things will typically mature. And in fact, the vast majority are dramatically shorter than that. Most money market instruments probably have less than or equal to 3 months to maturity from their date of issuance, even though the cutoff point is normally considered a year. In fact, a significant number of money market instruments, one we'll mention briefly later, repurchase agreements, the vast majority of them are overnight transactions. But point being, these always have short maturities, a year at the long end, but the vast majority of these 3 months or less, many a day. They're also going to be considered very safe. In other words, high quality. High quality, in other words, these are instruments that have very little credit risk, or that's the perception of them when they come to market. In other words, there's not a high yield money market instrument or a junk bond equivalent money market instrument. So these would qualify for upper investment grade ratings, although the rating system is completely different. So instead of AAA, AA, single A, one of the rating agencies uses Prime 1 for the very highest credit quality. Prime 2, P being abbreviation for prime, although it's oftentimes expressed that way, is the second highest credit rating for money market instruments. So short-term very safe, and because of those two factors, they also tend to be very liquid. Now, most securities to be liquid, it's because they're parts of large issues, and so there are many interested parties buying and selling and holding them as investments. But in the case of many money market instruments, one we'll talk about briefly in just a few moments, bankers' acceptances, they're one-offs. They're not parts of large issues. They're instruments used to finance individual transactions. Nonetheless, there is some reasonable liquidity because of the high degree of safety and the relatively short time horizon. Because given a short time horizon until the ultimate maturity, you can probably make a better assessment of the credit risk over that short time horizon than you could when you're looking at the credit risk associated with a 30-year bond or a 20-year bond. Now, just briefly, the four types of money market instruments we'll talk about at least in a little bit of detail. Commercial paper are corporate obligations, usually issued as discount securities like the T-bills we talked about earlier. And in fact, they have a maximum maturity of no more than 270 days. So that's less than here, of course. Why 270 days? Well, it might seem arbitrary, but it's a result of securities regulation in the United States. Remember the trust indentures we talked about before? Well, they can be expensive. You got to hire lawyers to write them up. You got to pay a trustee an annual fee. Especially if you're borrowing money for a short period of time, those might be relatively onerous expenses for a short-term borrowing. So as long as the borrowing is for 270 days or less, you don't have to have a trust indenture. That's why all commercial paper will mature in that time and less. And as I said before, like my earlier comment, most commercial paper probably matures in 3 months or less. Sometimes it's 7-day or 1-week commercial paper. Bankers' acceptances also are discount securities. Although they're issued not to borrow money, they're actually issued to finance transactions. Sometimes domestic, but more typically international transactions. Because if you've got a bank issuing a letter of credit on behalf of the buyer, it goes to the seller wants money right away, they take it to their bank. The seller's bank probably sends it back to the buyer's financing bank that issued the letter of credit initially, and when the bank gets it back, it stamps it accepted. That's why it's called a banker's acceptance. The bank could sit on that money until they got the payment from the client, but the bank probably has higher return uses of its funds, so it'll sell that banker's acceptance to some investor. From their perspective, it's almost like a T-bill, but not one issued by the federal government, rather one issued by a commercial bank. Negotiable CDs, certificates of deposit. Those aren't the CDs you see advertised on the rate board when you walk into the local branch bank, because those are CDs as well, but those are typically $1,000 or $5,000 minimum. Negotiable CDs, $100,000 minimum. And understand the implication of negotiable. What it means is you have the right to negotiate the transfer of ownership to somebody else. So these certificates of deposit are time deposits. In other words, deposits where the bank can impose a penalty if you make an early withdrawal. So if I actually literally took my money out of the bank, I'd suffer a penalty. In fact, if I bought a 6-month CD and took my money out after a week, the interest penalty would probably be so great I'd get less money than I deposited in the first place, as the penalty would be more than the interest earned over those 7 days. On the other hand, I can get my money out of the investment without suffering that penalty, not by making a withdrawal from the bank, but rather selling the deposit to someone else. That's the implication of negotiable. Anytime you see the phrase negotiable instrument, negotiable security, it means the holder has the right to transfer ownership to someone else. And the last one we'll mention, a very significant instrument in the financial markets, is repurchase agreements, oftentimes called repos. Well, repurchase agreements are really collateralized loans because a broker-dealer is selling securities to some other investor, at least in theory, but at the same time you write up the order ticket showing that sale, they're writing up another order ticket showing the broker-dealer repurchasing those very same securities. So in effect, even though they're called repurchase agreements, The formal name is actually sale under repurchase agreement, although most people don't realize that. But what they really amount to is collateralized loans. But it turns out they're very handy financing vehicles. So even though they originally were evolved as a way of circumventing legal or regulatory restrictions, it turns out that this is a market that's expanded worldwide after it evolved in the US in the 1950s because it is such a handy financing tool. Now, with government agency securities, let's focus on how they differ from the types of securities we talked about previously. Because in terms of structures, you don't see much different than all the various things we've looked at previously. So they could be fixed rate or floating rate coupon. They could be discount securities or zero coupon instruments. They might be callable. They might be non-callable. So you don't see anything here in terms of the features of the securities, the terms of the interest and principal payment and embedded options. You don't see anything here that we haven't encountered in one place or another over the course of discussion. So what's really different is what sort of risk are you facing that may be different here than what we've talked about previously. And I don't mean in terms of reinvestment risk or the sensitivity of price to an interest rate change. I'm really focusing more on the credit risk considerations here. Because you'll note if it's a government agency, and note it's not necessarily just a government agency, it might have some other name, it might be called a department or something else. In fact, it might be a business that's operated by the federal government, but it's treated as an entity of the government itself. So we're talking about legal agencies or entities created by the national government. But note that just because it's been created by the national government doesn't mean it's necessarily guaranteed. Some entities, agencies, departments created by the government that have the ability to issue debt will have their debt guaranteed by the government. But in some cases, it may not be guaranteed. So don't make the simplistic assumption that if it's a governmental agency that's doing the issuing, that the credit risk is necessarily the same as the supervising government. It, of course, has a big impact on whether the government is or is not guaranteeing that agency's debt obligations. Now, as I said before, the contractual cash flows, we're not going to see anything different here because there's a variety of maturities from very short maturities of overnight or a month or a quarter to a few years to many decades. And again, the coupon rates hit all the varieties we talked about previously, some fixed, some floating, some zero coupon. And again, sometimes there's various embedded options, calls being quite common as a matter of fact, but that varies by agency to agency and even country to country. But the credit risk assessment then has to consider what's the source of funds the agency has to pay the interest and return the principal on the debt securities they've owned. In some cases, they're charging user fees to the businesses or individuals that have to register with them to get driver's licenses or to get approvals to start new businesses or to take out a mortgage loan. There's a wide variety that we couldn't even list if we had the full day. So it might be fees for usage of the facilities maintained or operated or the permits issued by such an entity. Or in some cases, these agencies will have dedicated tax revenues. So some share of national income taxes or some share of national sales taxes or something like that. Or sales taxes on specified items might be one or the primary source of revenue. Or in fact, there might be a national government budget allocation to support that particular agency. So the considerations are, one, what are the sources of cash flow? And to the extent that that source or sources may not prove adequate to service the debt, what sort of guarantees, if any, come from the sponsoring government? So in most cases, government agency debt will be viewed as just a notch below, if not exactly equal to direct government obligations, especially where the government has guaranteed that agency explicitly. Although in most instances, even where there is no explicit government guarantee, most market participants will think, well, there's an implicit government guarantee of one of its agencies, but you clearly have to view it on a case-by-case basis. Now, the final category of securities we'll look at are securities issued by lower levels of government, that is below the federal or national level. So these might be states or provinces or prefectures, depending upon the title given to the larger administrative units inside of the country, or they might be at a much smaller level, the city or the county or the borough, as the case may be, again, depending upon the terminology used in the specific country in question. So this is a type of government debt, but usually they don't call it government debt. They'll refer to it as municipal debt or state debt. So the larger administrative units, again, are typically states or provinces, although some countries use other terminology. You have states in the US and Germany. You have provinces in Canada. But there's a variety of names that is used to describe those administrative entities, and it varies a lot from country to country. In some countries, you'll see significant issuance by that level of government. The provinces in Canada, the states in the United States are significant issuers of debt securities. On the other hand, in places like the UK or Japan, they don't have those administrative units. It goes from the national level much more down to the local level. And local governments, cities, counties, and many others. In the United States, school districts, water districts, park districts, highway districts, flood abatement districts. There's a wide variety of administrative entities that might issue debt to raise money to do something. Build highways, build flood control facilities, and things like that. Now, the general considerations, as indicated here, vary dramatically from country to country. So it's hard to make general statements other than broad descriptions. And the safety or riskiness is heavily affected by local rules and regulations and local tax laws. And the primary consideration when you're considering safety beyond the legal framework is, what is the source of cash flow? And is that source of cash flow likely to be predictable and adequate to service the debt as well as cover other requisite responsibilities? Because in many cases, whatever the source of revenue is, the first allocation of funds is the operating and maintenance expenses to run and maintain the facility that this entity or agency is running. And it's only after meeting those operating and maintenance expenses that money might be allocated to the bondholders. And note, the maintenance and operating expenses don't always go first. Sometimes the debt service comes first. But again, that varies from case to case and country to country. So if we look at some of the details, one broad category of such securities are what are sometimes called tax-backed bonds. In other words, they're backed by the full panoply of taxes that that level of government has access to run its operations as well as service its debt. In the United States, those are known as general obligation bonds, sometimes simply called GO bonds. Anytime you see that phrase, full faith and credit backing, that generally means the issuer will make use of potentially any source of funds coming into its possession to service that debt. And when it's a tax-backed bond like that, the debt service is payable from all the revenues that that entity of government has access to. And mind you, it's things that are called taxes, like income taxes, sales taxes, excise taxes, real estate taxes, and what taxes governments impose and have the right to collect, again, vary dramatically from country to country, and even province to province or state to state inside of a country. But understand, when I say that the general obligation bonds are backed by, you sometimes see it said they're backed by the full taxing authority of the state, understand it doesn't just mean what's technically called taxes. Any monies the governments can force you to hand over to legally conduct what you want to do, that's a tax in the sense we're talking about. So if you have to pay a fee to drive your car, that's a tax in the sense we're talking about. If you're an accountant and you have to pay the state a fee to conduct your business as an accountant, that's a tax in the sense we're talking about. So such bonds are generally perceived as safe because they have a wide source of revenue backing. But the other complication is generally the bondholders are competing with other claimants against that entity of government, the current employees, the citizenry who are expecting services, the retirees who are expecting pension benefits. So such bonds, while considered safer because they're backed by all sources of revenue, they're also very hard to analyze because the bondholders have one of many competing claims. And the last category of bonds we're going to talk about are revenue-backed bonds. Those are bonds that are backed by a specified source of revenue. That specified source of revenue might be project revenues, that is, revenues generated by operating the project or facility that was built or acquired with the proceeds of the bond offering. In other words, issue bonds to raise money to build a toll bridge, and then recover the money to maintain the facility and pay the bondholders by the tolls you're collecting from the trucks and other vehicles that cross the bridge. Well, revenue bonds are much easier to analyze because there's only one or a narrow specified number of revenues. And note, one of the revenues might be special taxes dedicated to servicing those revenue-backed bonds. But the analysis is also more contained because you can make better estimates of what are the costs of building and or maintaining that project. What are the costs of operating the facility? So these sorts of bonds are much easier to analyze than general obligation bonds because the analysis is much more constrained, but it's also thought they're potentially riskier because now, rather than being backed by all sources of revenue, such bonds are backed only by a specified source or sources of revenue, again, most commonly being either the project revenues themselves, money generated by operating the facility built or acquired with the proceeds of the bond offering, or special dedicated taxes. So I hope you found this presentation on fixed income securities very informative, and we'll talk to you again on other topics. Welcome to Types of Fixed Income Securities. In this